Hello everyone, I'm Kyle Cheropita, and this is The Upside. Most global markets in January started strong before being shocked by a new wave of tariff threats from the White House. Markets have since showed resilience, leaving many wondering what's next. Today, we'll be looking at a handful of FidelityConnects highlights from January. Connects is first presented as a live webcast for financial professionals and then released publicly as a video podcast with new episodes dropping daily. So let's take a look at January's big stories, starting with Patrice Kirion, portfolio manager of several funds, including Fidelity Global Concentrated Equity. Patrice sat down with host Pamela Ritchie and looked at global power shifts and what has or hasn't changed to start the year.
The reality is we spend a lot of time at the beginning of every year sort of thinking of what will be the new story in 2026 or whatever year we're in. The reality is the market doesn't care that this is the beginning of a new year. So as you should expect, the reality is our theses don't change overnight because we are in January. So as a result, most of my investment views are unchanged versus where we were last year. My views remain that international markets are starting to gather more attention. Flows are going back. Interest is going back. The valuation differential remains. It is a little bit less than it was at this time last year.
Because it was such low levels at that point.
Yes, last year we were probably like peak negativity right after the US election on international markets. That has changed in a big way over the course of the past 13, 14 months. But I think it remains. There is like a valuation differential, positioning differential that can create opportunities in international markets. What has not changed in my case, through the course of last year, I think Europe got a decent lift. So we were more selective from a big overweight position. We've taken profit in many areas, and we've allocated that to a good extent to Asia, and particularly China. That has not changed. I still think there is a very good risk-reward potential towards the Chinese equity market, notably around the consumer sectors, the technology, where there's some important breakthroughs coming out of there. Maybe one thing that is starting to change a little bit in my view of the world is after quite a few years of being significantly underweight in the US, notably around the tech sector, we are starting to find opportunities around the consumers, the consumer sectors, or the sectors that are going to benefit from lower interest rates, which I think could be something different about 2026. We'll see the lag effect of the rate cuts that did take place and could continue to take place, maybe starting to lift the real economy. And this is a thematic that will apply globally, including in the US. So I am spending more of my time looking at generally more consumer, real economy, housing, transports related cyclicals everywhere across the globe. And I think that's an interesting opportunity for the year ahead. That is different than last year. And
it sounds less regionally specific.
Yes, I think that's fair. Well, the past number of years, there's been enormous regional differentiation given the weight of the tech leadership, which is so heavy in the US, much less present in the rest of the world, given the slowdown that we've seen in China and the repercussions that has on Asia and Europe to some extent. I think this is likely to have less of a continued effect. And if anything, maybe a risk of reversal on that.
That's interesting.
But the pickup or the hope for pickup that we're starting to see signs of on the real economy, largely driven by lower rates globally, that has the potential to bring a reemergence of consumer confidence on like the traditional economy, traditional sectors. And I think this is pretty much the case across all the big geographic continents.
Patrice joined our French Dialogue Fidelity show as well, so check out that replay if you're interested in content en français. Up next is Chief Investment Officer and Portfolio Manager Andrew Marchese, who kicked off January with an examination of market cycles. Take a look.
For those who have heard me speak, I think over the course of the last year, I've been working with a hypothesis that largely due to the amount of stimulus in the monetary system, which goes back to the global financial crisis and beyond, the amount of capital kicking around there is enormous. And what it's actually doing is it's changing the boom-bust nature of both local, so let's call it a country or regional economy, and a more broader global economy. We don't have the boom-bust cycles that we have had historically. Now, a garden variety kind of economic cycle, you think of like a recessionary cycle that typically lasts anywhere from 5 to 10 years. So the early 80s and the early 90s would be kind of, symbolic of that. But the last cycles have been really caused by exogenous events or too much speculation, too much debt, and we keep curing those problems with more stimulus.
So COVID.
COVID was a big one. The global financial crisis was another one. And so we never extracted the capital out of the system. It just keeps growing. And that has an effect of now we go through periods of time where we're oscillating around 50. So both expansion and contraction in both manufacturing and service metrics, not only in the United States, but globally. So the market's paying more attention to the rate of change or a positive or negative inflection, as opposed to necessarily the magnitude of change, which was more commensurate with those cycles in the 80s and 90s. You would have a recession, you would have global profits recessing as well, and that would kickstart stimulus and whatnot to kind of cure the recession. And then you would have a 5 to 10 year playbook for the market that would involve, what leads at what point in the cycle, what sectors tend to do better or worse, how do profits kind of migrate through there, and obviously what we care about is how do equities behave.
Sure.
It's
early
gotten
cycle, late cycle, mid cycle.
correct. So now I think we're in an environment, and we could be for the foreseeable future, where sectors that lead are not typical based on where you think you are in the economy and you have this overarching secular theme of, in this case, innovation. So that would be AI.
Industrial revolution, essentially, going on at the same time.
Right. And that industrial revolution has second derivative, like increasing energy demand and things like this, which has implications for hard assets like copper and silver and so on and so forth. And so all these things don't follow the traditional playbook. So what I think it really requires us to do is really examine, what has worked, what hasn't worked, what risks are either priced for or not priced for, and where do we think better relative risk returns may be in the marketplace, which may not necessarily rhyme with history.
The global scramble for minerals and materials has been heating up, and markets are certainly taking notice. From uranium futures to silver and copper hitting fresh highs this month, the demand for the building blocks of what will be our new modern life is accelerating fast. Here's equity research analyst Claire Fleming, who covers materials.
I think it's maybe helpful to start with the bigger picture in terms of what's been driving commodities. We'll get into lots of the different sub-industries as we go, but there's been a lot of positive drivers at the macro level for commodities as a group. For example, we've seen lots of fiscal stimulus, both in Western countries and in China from governments. We're seeing a weaker US dollar and a shift away from US dollar denominated assets globally. And we've also avoided the worst case scenario from tariffs in terms of the economic growth outlook that people were concerned about at points last year. And we're seeing a lot more government support for various areas of the resource sector. So with all those drivers at the macro level, that's creating a lot more positive momentum for the commodities group that I've been covering.
So it's interesting because you would sort of think on one level, just the very existence of AI, the scramble, and the discussion of what needs to go into all of these data centers that we have lots of demand for would be enough to get it going. But it is actually money to be invested right away that is coming in the form of governments and other types of debt vehicles, essentially, that seems to be getting things going, isn't it? Why isn't there enough money / resources there to get some of these new projects off the ground?
I think it's been really interesting over the past year to see the change in government support globally, but of course focusing more on the US and Canadian government actions. I think we've seen across resources and commodities ranging from lithium and graphite, scandium, other types of critical minerals, that we've seen a range of support from either direct equity investments from various government-related agencies, or also more creative structures like offtake agreements or partnerships.
What are offtake agreements?
So that would be helping to have a partner secure their supply longer term by signing that contract up front and maybe providing capital to help provide the funding plan until that can get into production. And I think although there's lots of creative funding structures that you can use, really the goal of this is to help address that financing challenge that a lot of resource projects can have in terms of accessing that capital and not being too dilutive to existing shareholders if they're a public company, and getting to that point where they can be in a longer term production profile.
So we've heard about some big mergers within Canada that affect Canada directly, but also Glencore, and Rio Tinto also, which would be an absolute behemoth if this goes through. They've been dancing for a while about whether there's going to be a merger or there isn't. Again, these big mergers, big announcements, big players, there's lots of questions to ask you there, but I might just begin with, how do you get sort of a pure play Canadian, I don't know, on copper or anything else, when you've got these big companies that own so many mines in so many places, and now it looks like there'll be even more of them?
Yeah, of course, M&A has been so topical for the copper industry over the long term, but especially over the past year with some of the consolidation or rumors that we've seen in the industry. And I think, of course, the big question that comes up whenever there's an M&A headline is who could be next in the industry. And I think it's great to work at Fidelity in those types of scenarios to help with both the qualitative as well as the quantitative analysis that's going into that. Of course, on the qualitative side, it's great to be working on a global team, and certain that my coverage group is more Canadian materials, but my colleague James is covering more of those global majors. Okay. And we chat and he can share perspectives on what companies might be more interested in pursuing M&A or what assets could be a good fit together. And I think on the quantitative piece, to understand that question of who could be next, you sort of put yourselves in the shoes of if you're a executive of a mining company looking at ways to grow, and the analysis of, is it more attractive to invest in building a new project from scratch or the development stage where you'd be investing the CapEx to develop that over time? Or is it more attractive to buy a company that exists in the public assets with producing assets just based on the implied valuation in public markets? Which is, of course, an interesting trade-off, given that if you're acquiring a company, you're taking away a lot of that development or project risk during construction, and you're also getting that cash flow immediately compared to investing in a development project that would take several years to get to that production stage.
Do we have to do both? I mean, do we have to build new mines as well, which will be longer term, obviously, and will both happen?
I think in conversations with companies, it seems like a lot of executives are open to considering both. Of course, as conditions evolve, things can change, and there might be certain projects that are still attractive to be developed on a standalone basis. But a lot of these companies have a fiduciary duty to consider what's in the best interests of all stakeholders and weigh whether it's more attractive for them to grow via acquisitions or organic growth. And I think it's interesting to see with the Anglo Tech transaction that, of course, was topical. A lot of that transaction rationale focused on the potential synergies that can be created by leveraging the infrastructure between some neighboring assets. So I think there's some examples like that that can also come into play if there's synergies between certain assets that can make the rationale for M&A more attractive in the industry as well.
A question for 2026 may not be whether the US economy slows, but whether policymakers are willing to let it run hot. After years of narrow leadership dominated by megacap tech, investors are wondering if in 2026 the market can or will broaden beyond the Mag 7. Chris Lee, Fidelity US Chief Investment Officer and Portfolio Manager, sat down with host Glenn Davidson, and here they talk about AI as a theme. Take a look.
So AI is clearly important, both as a driver of the overall economy as well as the market. So if you look at the S&P 500, again, the top 10 stocks represent about 40% of the index today. And most of those stocks are in the technology, comm services, or AI related in nature. So, we have great recognition, I think, that AI is a generational platform shift from a technology standpoint. It's a profound capability that I think will really impact, both consumers and enterprises in a very significant way. But it's very compute intensive and requires a lot of resources, including power, and other things that really haven't had a ton of investment up to this point. So that resetting of the growth and demand curves have really powered a lot of the stocks that are in that supply chain. So one of the questions as we enter 2026 is where and how will those investments pay off? What is the return going to be on the tremendous amount of capital that's being deployed, not just in compute, but also, again, data center infrastructure and the underlying investment that's required to support this product cycle. And, I think that's going to be a very important topic as we progress through 2026, and in particular have a big impact as a result of its size in the index on how the market overall does perform.
And I suppose a big factor now, and certainly we've heard about it the last couple of days, is power for data centers as an example. And should that extra cost be bared by the consumer, or should it be by the tech companies? And that's something obviously causing a bit of gyration in the market. I've got to ask, you started at Fidelity, if I recall correctly, around 2004, and you were responsible, and this is just after the tech meltdown, and you were responsible for analyzing semiconductor stocks. When you were doing that, it was a crazy time, obviously, and think about when you started to do that and where semis are today. Can you compare and contrast for us, or just like, what's it mean to you as someone who really had your formative part of your career in that world?
Yeah, it's been really great to reflect on how the industry has changed over the past couple of decades. I think number one, there's been tremendous consolidation on the supply side. When I was covering semiconductors back in the early 2000s, every company or many companies were building their own what they call fabs. So they were vertically integrated and they produced and manufactured their own chips. What happened with Moore's Law was that the manufacturing expertise became much more specialized, and that part of the manufacturing or value chain became outsourced, and the industry overall became much more vertically segmented. So fast forward to today, you've got big companies like Taiwan Semiconductor, which is the world leader in manufacturing chips, and their customers are design houses, essentially. The NVIDIA that we all know about, Broadcom, even AMD, which had their own factories for a long period of time, is now largely a fabless company. So, that's had pretty interesting implications around the pace of innovation, number one, and number two, the cyclicality of the industry, where there isn't necessarily as much boom bust, contours from oversupply and overcapacity going to undersupply and undercapacity.
Well, it must be fascinating for you to keep an eye on, considering your foundation at Fidelity and where the world is today. So leadership's really been on a few key companies. If we look at the S&P, what do you think about the S&P 493 as we go through, as we start in 2026?
That's a great question, Glenn, and I think something that's going to be very pivotal as we, traverse this year. So if you look at the relative growth rates, earnings growth rate of the, let's call it Mag 7 as a proxy for sort of the AI cohort, and the rest of the S&P 500, the 493 as you termed it, those rates are starting to converge if you look at, consensus estimates, where the Mag 7 is expected to grow earnings in the 20% plus or minus range. And that's actually a deceleration from the past few years. So still good, but slightly slower relative to what we saw in 2024 and 2025. Conversely, the 493 is expected to see earnings accelerate towards the mid-teens level, up from about 10% last year, round numbers. So that, we live in a relative world, and that sets up an interesting question as to what and if there could be a handoff in terms of market leadership from, as you mentioned, the Mag 7 or the large companies to the rest of the index. There's a number of fundamental kind of underpinnings that might support that as well. For example, the Fed started cutting interest rates, and that tends to be better for and benefit companies that are more in the old economy realm. Within that also tends to be favorable for smaller cap companies. So overall, you may it wouldn't be surprising to see some transition in leadership given those set of conditions that we just talked about.
Finally, to wrap up today, we'll hear from David Tulk, portfolio manager on Fidelity's global asset allocation team. David shared his latest insights and what's top of mind for the GAA team in Q1 of 2026.
Last year, ahead of the move, really, you were making sure that you were allocated internationally.
Right.
At the very beginning of last year, that was a head scratcher for many, or not what you were doing, but just it wasn't something on people's playlists at that point. It worked out incredibly well. Is that an area that you'll look at as strongly this year?
Yeah, I think it's a trend that will start to become better appreciated, especially among U.S. investors. So that was really one of the big surprises last year, and was one of the really large portfolio shifts that we've talked about before, is that we started last year with a pretty hefty overweight to the U.S. and to the U.S. dollar, and as the early part of last year unfolded, it became very obvious to us that that wasn't the right positioning. So we made some pretty significant strides to move to being underweight the U.S. dollar and also underweight U.S. equities. And I think as we start this year, I mean, that was clearly the right move to make last year. But as we start this year, I think that trend could certainly continue, because I think a lot of the things that are happening under the surface continue to be U.S. dollar negative. And I think as that theme starts to become better understood in the market, you might also see other investors try to position for that. And that could be an extension of the type of move that we have seen in the currency. Because the U.S. dollar is a longer term sort of cyclically driven currency. And these long trends, they can last 5, 10 years. So I think we're still in the early stages of that. And again, a lot of that's catalyzed by what we're seeing out of the U.S. administration and a lot of the stuff that we're seeing outside of the U.S. as well.
When we think of the word broadening and a broadening trade, do you think that should be extended to an international trade? Because often we'll talk about sort of the other 493 and so on, but a broadening trade means what?
Yeah, I mean, there's definitely the narrow definition of broadening, which is itself a bit of a contradiction, but
yes.
You think of it as in terms of the just within the United States, where it's obviously been led very much by AI-focused companies and growth more generally, and that broadens into value and small cap, and we can unpack that certainly. Sure. But I think the way that we've thought primarily about broadening is largely outside from the U.S. to the rest of the world. So again, the positioning tilts that we have is still to be modestly underweight the United States, seeing more opportunity in Europe and Asia and emerging markets. And as you mentioned in the intro, looking more favorably towards Canada as well.
So let's sort of insert the discussion of interest rates into a dollar story, lots of other things as well, because it appears, and I think you have commented, or others who certainly have commented on the fact that if we go back to which country or region is in which part of the cycle, the U.S. is in quite a different point, and Canada, for instance, really got going quickly on cutting rates, and now here we are. It appears to be at the end of the rate cutting cycle.
Yeah.
How does that bode for investing?
No, absolutely. So I think in the United States, I mean, this is also something that really keys back to the dollar story too. So, you've seen the Federal Reserve cut a couple of times, and their policy rate, it's fairly close to what I would say is generally neutral. And I think it's consistent with what the wider economy is suggesting they can do. So they could cut a couple more times, but generally speaking, they're in the right neighborhood. But I think the key risk that will unfold, and this year is especially relevant, is that you're going to get a new Fed chair. And we're going through the candidates right now, and there's a lot of jockeying taking place both on Twitter and behind the scenes. But
it's like a presidential run for something.
Exactly.
It's going on forever. But,
okay. Yeah, no, but we're being given some notion that this should be a decision that's made in the next couple of weeks or fairly early in the year. So what we'll end up seeing, I think, is then again the risk that monetary policy isn't being set exclusively for economic reasons, but there's now a political overlay. Because as we've heard from the administration, there's a very clear desire to see lower interest rates regardless of what's going on in the economy. So if the successful candidate for the Fed chair is sympathetic to that narrative, then again, you start to see interest rate cuts that, again, are largely driven by political considerations. And then that has a very clear implication for the direction in the currency. Not only is it raising fears of a lack of central bank independence, which again is sacrosanct to a well-functioning currency, but also, again, just speaks to that interest rate differential that's beginning to shift further away from the US dollar. And then that brings us to Canada,
Yes.
where, as you mentioned, the Canadian rate cut story, I think that's more or less done unless something really goes wrong with the economy. So if you actually look at the way the market is priced today, there's some probability that the next move by the Bank of Canada will be a hike.
Right.
And part of that was catalyzed on a really strong GDP report. But again, when you look at where things sit, Canada moved early and moved by a lot. And now we're kind of working our way through a lot of the reasons why the Bank of Canada cut. So if the economy continues to remain on track, at some point you can imagine that that would then necessitate the Bank of Canada to potentially take some of that stimulus away. Again, not tomorrow, not even in the first half of this year, most likely, but at some point it does serve as a reminder that central banks are inevitably cyclical. And at some point, you're going to start to see the other side of that. And that's one of the things that I think maybe not a 2026 story globally, but as a forward-looking investor, you just have to keep that in the back of your mind and not be too conditioned to just think of that central banks move in one way, and that's to cut interest rates.
Thanks for watching today. So each of those clips was from a full 30-minute video podcast, which are available on YouTube, Spotify, Apple Podcasts, and more. We're putting out fresh content daily, so please look up FidelityConnects or the Upside podcast for more. The Upside starts as a streamed webcast, so to not miss a show, head to fidelity.ca and sign up for the next webcast. Thanks for watching today, and I hope you'll join us again on The Upside. I'm Kyle Cheropita. Thanks for listening to, or watching, Fidelity Canada's The Upside podcast. Subscribe on your podcast platform of choice so you don't miss an episode. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on LinkedIn, YouTube, Instagram, or X. We'll wrap things up today with a quick disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.